Hello and welcome to the forum. Every week, we take no more than 15 minutes to discuss the 3 highest conviction ideas surfaced across the Smartkarma network, cutting through the noise and helping you zero in on what truly matters most. The live forum and Q&A session are exclusively available to Smartkarma Plus subscribers. You can always revisit previous episodes on this YouTube channel. Without further ado, let's dive into this week's ideas.
Good evening, ladies and gentlemen, and welcome to the Smartkarma Forum. The forum is a high-impact weekly live webinar exclusive for Smartkarma Plus subscribers. We discuss the best, highest conviction insights surfaced across the Smartkarma network. The forum is meant purely for informational purposes and does not constitute investment advice. It is the opinion not of Smartkarma, but that of our insight providers, and Chatham House rule applies. At the end of every week, we take the latest forum recordings and upload them to our YouTube channel. This allows you to consume them at your own time and pace and also share them with friends. This week, we will revisit Oriental Watch, one of the long-standing ideas discussed several times previously on the Smartkarma Forum. We will then look at Meituan, which is one of the larger Chinese tech companies. And finally, we will look at the Taiwan Strait dispute, escalating China-US tension, and very specifically the impact on Chinese healthcare companies. Oriental Watch. The ticker is 398 Hong Kong. This is a small cap listed in Hong Kong that has been a long favorite on the Smartkarma platform. As you can tell from the chart on this slide, the name has done reasonably well, especially relative to market conditions. But what is quite spectacular here is the dividend yield that this company has paid out over the same period. Few things first. What is Oriental Watch? Oriental Watch is one of the largest retailers for luxury watches across Hong Kong and China. We noticed that 2022 was a cyclical high for its earnings. We expect 2023 to be a year of moderations, with earnings to be lower year on year. Channel checks indicate that Rolex and Patek demand is still good. In fact, Hong Kong demand has inflected positively, especially as quarantine rules have relaxed. This is contrary to the moribund news that has been going around at the moment. Meanwhile, dividend payouts remain really robust, with FY23 yield at 15.4%, and cash is still more than 50% of market cap. This means special dividends could come on top. Long-term investors will like this yield. Cyclical investors, however, will wait for more data points. Moving on to Meituan 3690. This is a large cap tech name in China, and the insight we're referencing comes from Shifara Samsudin. Meituan is a web-based shopping platform for locally found consumer products and retail in China. It entered the community group buying market in the third quarter of 2020, but its huge losses there have dragged down consolidated profits. We noticed that regulators have recently probed the company over food safety problems, as well as price war has continued to increase with its competitors. We note that China continues reducing anti-competitive practices and have introduced a lot of new laws to improve the well-being of delivery riders. The first quarter earnings were not severely impacted by Omicron, but we expect the second quarter to be fully impacted. On top of this, there is news, although unconfirmed, that Tencent might be looking to monetize its large stake in Meituan as well. This would mean that the name remains under sustained pressure for a period of time. We'll move on to the third and final topic for today, which is the Taiwan Strait dispute, China-US tensions, and specifically the impact on Chinese healthcare. This is an insight published by Xinya Wong, also known as Chris Wong, on the Smartkarma platform. We all know that Pelosi's recent visit to Taiwan has sparked a dispute across the straits and has added to more tensions between the US and Chinese government. What is perhaps less well known is that Taiwan has one of the most advanced healthcare systems in the world and is a major center for clinical research in Asia Pacific. Chinese pharmaceutical companies have used Taiwan extensively for clinical research as well. Ongoing disputes will impact Chinese healthcare, i.e. pharma, medical devices, as well as services companies. Chinese pharma companies will have to incur time and cost to adjust patient recruitment plans and clinical trial protocols. On top of that, chip shortages from Taiwan could cause supply disruptions for Chinese medical technology companies and device players as well. Accordingly, we expect China will continue to accelerate substitution in imports in all links of the healthcare industry chain and continue to build towards self-sufficiency. Domestic players that are aligned in this direction will benefit. Let's continue the conversation on these topics and more on Smart Karma. Thanks very much.
That's it for this week. You can find more ideas like the ones we discussed today on demand on our YouTube channel. Remember to subscribe and hit the notification button. If you like these ideas, spread the word. Tell a fellow investor about Smartkarma Plus and follow us on social media. Just search for Smartkarma. And of course, don't forget to visit smartkarma.com for more independent, differentiated investment insights. Thanks for watching and see you next week.